Hi fellow investors, I hope you're all doing well out there. The market has been very volatile with the unfortunate war going on in the Ukraine and the upcoming interest rate hikes. In this video, I'm going to share the top 10 holdings in my portfolio as of March 2020. They make up about 45% of my portfolio total and not all of them are in the green. Majority of my top holdings are high growth stocks and they would continue to get pressure on the valuation, especially in the short term. It's hard to stay invested in a market like this, but I would stay invested in the market as a long-term investor, and I believe dollar cost averaging when possible is better, especially if there are bargains in the market. Anyway, this is just my personal opinion and not a financial advice. The first stock is ENPH Energy, ticker symbol ENPH. It's a 6.4% allocation, the largest in my portfolio. At the all-time high, it used to have a 400% return, but now only about 120% return remaining. So ENPH Energy is an American solar energy leader that provides software-driven management technology for residential and commercial solar plus storage solutions. They reported a double-beat earning on their last Q4 earning release and issued a robust guidance for 2022. The company has continued demonstrating its pricing leadership, comprehensive product suite, and the ability to navigate the supply chain constraints. They also repurchased 300 million of shares back in December, so the management viewed that the stock was undervalued at $197, and it's currently $158. For now though, I'm not adding just yet since it's a large position already. The second company is Microsoft, ticker symbol MSFT. It's a 5.4% position with a current return of 35%. This mega cap has beaten analyst expectation in the last 4 quarters. In my opinion, Microsoft is fairly valued with a current price of $287. It's hugely profitable and Microsoft also has multiple growth drivers. They are rapidly expanding their cloud offering, including making their cloud security solution available to customers who also use competing platforms from Amazon and Google Cloud Platform. They're also on the path to provide industry-specific solution for healthcare, manufacturing, retail, and so on. Their investment in gaming has also paid off with Xbox, and they'll continue to capture more market share in the gaming industry with the acquisition of Activision. It's also aiming to capture the share in the emerging metaverse market through the release of AR and VR products. The third company is Crowdstrike. It's a 5.1% position with a current return of just 5%. The Russian-Ukraine conflict has thrown the impact and significance of cyber warfare into the focus once more. Crowdstrike is the leading next-generation endpoint security leader in the market. They are in a good position as government and corporations reviewing the adequacy of their cybersecurity systems. It has a strong balance sheet and growing operating cash flow. Although it has a very high valuation with the traditional metrics, but considering the growth and more focus on cybersecurity, the stock could be re-rated with higher multiples. For a high growth stock though, I wouldn't be surprised if we continue to see share price volatility the remainder of this year. The fourth stock is Advanced Micro Device or AMD. It's a 5% position with a current return of 25%. AMD has become a larger position in my portfolio as I was a shareholder of Xilinx. There are good synergies between the two companies that could benefit data center business, such as the combination of FPGA from Xilinx with AMD CPUs for hardware acceleration as well as cross-selling opportunities among their common customers. AMD had great earnings throughout 2021 and projected 31% year-over-year growth. Due to the timing, we didn't actually get a combined revenue projection, although some analysts argued that the growth rate would become slower. While it remains to be seen, with exciting new product launch planned this year and proven management track record, I believe AMD is still in a position to continue growing and gaining market share from Intel. The fifth stock is Tesla, ticker symbol TSLA. It's a 4.5% position with a current return of 90%. Excessive demand combined with supply chain constraint has left Tesla unable to fulfill customers' demand in recent years. They finally got the approval in Germany to start commercial production after months of delay, which is good news. Tesla had a great year in 2021 in terms of production and vehicle deliveries. The company financials are also growing stronger, but it still has a very high valuation even with the large drop year to date. The EV market is projected to grow into a multi-trillion industry, and Tesla remains as the top player. But rising competition would put pressure on the company in maintaining their market share. Partly for this reason, I haven't been adding to my position for some time now. The sixth stock is NVDA. It's a 4.4% position with the current return of 75%. NVIDIA started as a chip company producing high-performing graphic cards, but it has now evolved to a computing platform company with more software-driven revenue. NVIDIA is poised to ride the wave of multiple growing technologies from gaming to data center computing, artificial intelligence, autonomous driving, and even the metaverse. They forecasted strong revenue growth for the upcoming first quarter of 2022. While the ARM acquisition fell through, it's immaterial, and they still have close partnership with ARM. While they have high valuation, the higher multiple, in my opinion, is justified given the significant growth potential. The seventh stock is The Trade Desk, ticker symbol TTD. It's a 4.3% position with the current return of 22%. The Trade Desk is a smaller cap company in the advertisement technology space. It offers a marketplace that allows customers to purchase various types of advertisement to run global campaigns in digital media such as display advertising, social media, and advanced TV. Advertisers look to the Trade Desk as an alternative that provides them with more transparency compared to Facebook or Google. It's a founder-led company with a solid balance sheet. While the valuation remains high even after a 16% year-to-date and likely remains volatile, the company has had explosive revenue growth and still has a long runway ahead. The eighth stock is Etsy. It's a 3.2% position with a current return of -5%. Etsy is a high-quality e-commerce business that caters to the long tail of small businesses. It has also been consistently profitable. And though the pandemic has accelerated its revenue over the last 2 years, moving forward, Etsy expects a tough comparison, especially for this financial year. This is also one of the reasons for the dramatic sell-off in addition to the broader pressure to the growth stock in general. However, they exceeded the expectation in their recent earnings release. Etsy appeared to have found success in engaging and retaining the company's buyer, even as the tailwind brought by the pandemic has eased. It was also not much affected by the supply chain issues unlike some of its peers. The strategic acquisition, the growth projection, and the profit margin expansion, in my opinion, still makes Etsy as an attractive long-term position. So stock number 9 is Google. It's a 3.2% position with a current return of -6%. I was a shareholder of Google before but got out in 2020 for another opportunity, and just got back in recently to have a safer growth position in my portfolio. I was impressed by their last earnings release. It is a highly profitable company with a great balance sheet. Google is the leader in advertising with control over popular apps and platforms, and it doesn't depend on data tracking as much as some other companies. While others show lackluster results in advertisement revenue, Google reported growth of 32%. The cloud platform business is also growing much faster, although not profitable yet, as the company focuses on investing heavily in the business. Google is also successfully building a strong hardware business with rapid progress in smart home devices, smartphone, and other segments. The last company is Mercado Libre. It's a 3.1% position, and actually I'm down a whopping 30% on this one. Mercado Libre is the e-commerce market leader in South America, and it has also a thriving fintech business. E-commerce penetration is still low in South America, 4.9% compared to 13% in the US. Therefore, Mercado Libre has plenty of runway for growth. The company has a solid balance sheet and continues to report strong revenue growth of 77% in 2021. The gross profit margin, however, have declined mainly due to the investment into logistics, discount, and advertising. Inflation would further squeeze the company margin further, and so is competition. Sea Limited has entered e-commerce market in South America, but I'm not as worried because they don't have the same logistic infrastructure advantage, and so far it has only 5% market share. As the investment thesis for Mercado Libre is still intact, although my position has decreased in value significantly, I still believe in the long-term potential. So that was all my top 10 holdings in my portfolio. Over time, I would like to have a more concentrated allocation, but I still consider every stock in my portfolio when adding, especially more could become undervalued with potentially more volatility coming this year. Anyway, these are just my personal opinion. Always do your own research before making any investment decision. Good luck with your investment and see you next time.